Welcome back to the portfolio, everyone. Today we're going over 7 dividend aristocrats. All 7 of these companies have increased their dividend for at least 25 straight years, which is absolutely incredible. Dividend aristocrats have a history of outperforming the S&P 500. We're going to go over these top 7 names right now, and they're all in different sectors of the market to give you a little bit of diversity within your portfolio. Of course, dividend aristocrats are such stable companies that have been around for such a long time. 25 years of consistent dividend increases just shows that these companies can weather any storm, any recession, any depression, and continue to increase that dividend and return capital back to shareholders. So we're going to go over 7 companies who are dividend aristocrats. We're going to take a look at how these dividend aristocrats have performed over the past 5-10 years. We're going to evaluate how safe each of their dividends is, and we're going to just overall talk about these 7 names in general, which can all be part of a nice balanced dividend portfolio. Before we do that, everyone, I am the Gen Z investor, and every single day I come out with new videos that talk about different stocks you can buy, overall stock market performance, and any other big news or headlines. So please like and subscribe, and we're going to get right into it. So this chart shows the performance of dividend aristocrats versus the S&P 500 from 1991 all the way to 2016. So the orange line is the dividend aristocrats, and the blue line is the S&P. So what this represents is a total investment of $10,000 in 1991, and 25 years later, it shows the total return with dividends reinvested. So if you take a look, the S&P 500 in blue returned a total return up to $116,000. Meanwhile, dividend aristocrats brought all the way up to $191,000. So a huge outperformance by the dividend aristocrats. Of course, I'm going to say this right now, past performance does not lead to future results. We are not sure if dividend aristocrats will continue to outperform, but as investors, we use past results to kind of judge our investment decisions for the future. So holding dividend aristocrats within your portfolio can be shown to actually do very well over the long term. So I just want to show you that it is possible that these somewhat stable blue chip companies can actually outperform the overall market, and they have in the past. It'll be interesting to see if they can continue to do that long into the future. So we're going to jump into the first dividend aristocrat on this list, which is Pepsi. So we're going to get them out of the way. They are probably the most known dividend aristocrat right now because they are very close to reaching that dividend king status at a 50-year streak, but they are not there yet. So of course, ticker symbol PEP is Pepsi, currently trading at $133 a share. On the 5-year chart, you can see they were up very close to 39% on the 5-year chart. So beautiful upward trend. If we take a look at the 1-year chart, you can see, of course, they saw those March lows, but they have not fully recovered back to pre-pandemic levels where they were around $146 a share, which may make this a nice buying opportunities for people who want to jump into Pepsi right now. Of course, Pepsi is very diversified outside of just the soft drink. They are in a bunch of different companies, and they own a lot of snack food brands as well. Current market cap around $185 billion. This is an extremely large company, and we're going to take a look at that dividend because this is a list of dividend aristocrats. So today we're not going to take a look at the company's financials for each individual company. We're going to take a look at just at their dividend scorecard and evaluate how safe that dividend is. So if we take a look, Pepsi's current yield is just over 3%, so a beautiful starting yield. For a lot of companies, when you're looking for dividend income, a starting yield between 2 and 5% is the way to go. So Pepsi falls somewhat within that middle, which is beautiful to see. With a 76% payout ratio, so a little bit on the high side, but nothing too crazy. They have a little bit of money left over to reinvest back into the business, and they are continuing to pay out that juicy dividend with a little bit of room left over to grow that dividend year over year. So they have a 5-year dividend growth rate of around 8.4%, which is beautiful. That's a high dividend growth rate. You're getting that nice 3% starting yield, plus it's growing at an average of 8 to 9% per year, which is nice to see. And of course, they are still considered a dividend aristocrat because their dividend growth streak is at 48 years, very close to becoming a dividend king, and I am sure I can almost guarantee that they will reach that dividend king status within the next 2 years. With regard to how safe Pepsi's dividend is, they have a very, very safe dividend ranked at 93. So this is considered very safe, very unlikely that this dividend gets cut anytime soon. Stock number 2 on this list is another blue chip name that I got to get out of the way is Walmart, ticker symbol WMT, currently trading at $132 per share. On the 1-year chart, they're up 14.8%, and this is a company who has actually continued to thrive since the March lows. You can see here they've reached new all-time highs and continue to grow. massive market cap at around $373 billion. This company, of course, has been a staple across America for the last 50 to 75 years. If we take a look at that dividend, they have a lower starting yield at around 1.64%, but an extremely low 43% payout ratio, so with lots of room to continue to grow that dividend each and every year. They do have an extremely minimal 5-year dividend growth rate of only 2%, so they are not growing that dividend very rapidly, but they are maintaining their dividend income with regard to inflation. Inflation averages around 2% per year, so you are getting that bump in your dividend for at least the rate of inflation, so you aren't technically losing money to inflation each and every year. Of course, we would like to see Walmart grow their dividend at a faster rate, especially because they have such a minimal payout ratio right now. And of course, very close to becoming a dividend king, and I'm sure they will reach that point within 3 years. But for this list, they are still a dividend aristocrat at a 47-year dividend growth history. And how safe that dividend is? It's still safe, not very safe, but nothing too worrying with Walmart's dividend right now. They have that low payout ratio, the beautiful dividend growth history. I'm sure this dividend will continue to grow moving forward. Stock number 3 on our list is, now we have some nice high income stock right here, is of course AT&T. So AT&T gets talked about all the time. I've made a video last week talking about the differences between AT&T and Verizon. I did a quick comparison between the two. And of course, people who love dividend income are really jumping into AT&T right now on this dip. You can see here on the 1-year price chart, they are down 10%. They have not recovered from the March lows, which is great to see, which may make this a nice buying opportunity for AT&T. Pre-pandemic, they were trading around $38 to $40 per share, but right now they're at that $30 range, which may make this a beautiful time to jump in if you want to add some income to your portfolio through a dividend aristocrat. So we take a look at their dividend scorecard. They have a nice close to 7% starting yield right now, which is amazing. Sustainable payout ratio around 65%, so not on the high side, not on the low side, so very nicely in the middle. With the same dividend growth rate as Walmart, only growing that dividend at a rate of 2% over the past 5 years. So once again, not a very high growth dividend, but of course, when you're getting a starting yield at around 7%, nothing too worrying right there. And of course, they have a 36-year dividend growth history, so of course, they are that dividend aristocrat. And their dividend is still safe at a rank of 65. So of course, if they improve their dividend, to improve that dividend safety score, they have to bump up some net income, reduce some liabilities, and overall, their dividend safety score will go up. But I'm not too worried about AT&T cutting their dividend anytime soon. It is still considered safe. Moving on to stock number 4, it is Aflac, of course, the insurance company, currently trading around $36 a share. 5-year chart, they were up 17%. And if you take a look closer at the 1-year chart, you can see huge dip in share price. They saw those March lows, a little bit of a recovery, but are nowhere near back to pre-pandemic levels. So if you want to jump into Aflac, pre-pandemic level around $50 to $55 per share. Meanwhile, they're all the way down to $36 right now. With regard to their dividend, a nice starting yield at 3%. An extremely low payout ratio only at 26%. So they have 75% of their money reinvesting back into the business, and they are only paying out about 26% back to shareholders. And they have been growing that dividend very nicely at around 7.5% over the past 5 years. And they are, of course, a dividend aristocrat with a nice 38-year dividend growth streak. And with regard to dividend safety, they have the highest dividend safety score possible at 99, so extremely unlikely that that dividend gets cut anytime soon. With that low payout ratio, of course, it really makes it easy for these companies to continue to pay out that dividend each and every year. Jumping over to the next stock on our list, we have Walgreens. So if we take a look at Walgreens' share price, you can see it's currently trading at around $41 a share. On the 1-year chart, they are on a nice decline right now at around 27% on the 1-year chart. On the 5-year chart, they've seen complete downtrend around 56%. So this is one stock you cannot jump into if you're looking for share price appreciation. If you look at the 10-year chart, they are up 36%. So this is more of a company right now if you're looking for some dividend income consistently over the next couple of years. Walgreens may be one of the brands you want to look at right now if you're a little bit underweight within that sector. And if we take a look at their dividend scorecard, you can see they have a nice 4.6% yield. So of course, dividend is on the higher side right now. 40% payout ratio showing there are sustainable dividend payout ratio right now. They will continue to pay that dividend, and there is room left over to grow that dividend. And they have been growing that dividend at a nice 6.58% over the past 5 years. So of course, that nice starting yield with beautiful dividend growth may make this be a nice income play for your portfolio if you're trying to bolster up your current income within your overall portfolio. 43-year dividend growth history, nothing too shabby there, but almost on that way to becoming a dividend king, but not there yet. With regard to dividend safety, they have a 79, so they are very safe. They are actually 2 points away becoming a very safe, as categorized as very safe, which is where 81 plus. So they are on the higher side of safe. This dividend probably will not be cut anytime soon. So if you're looking for some current income in your portfolio, Walgreens may be the play for you. The next stock on our list is actually a stock. It is the REIT. Of course, one of the most famous and most talked about REITs is ticker symbol O, Realty Income Corporation, currently around $57 a share. And of course, because of the pandemic and the economic shutdown and our new somewhat stay-at-home economy, real estate sector is a little bit up in the air right now. So a lot of investors are weary about how the real estate sector is going to perform over the next 5 to 10 years. But if you are underweight in that sector, or if you believe real estate is going to continue to grow at a fast pace, ticker symbol O may be the company you want to take a look at. On the 1-year chart, they are still down 16%. And of course, you can see here they have not recovered back to pre-pandemic levels. Before this pandemic drop in March, you can see they were trading around $75 to $80 per share, now down to $57 per share, and have stayed somewhat flat over the past month. 5-year chart, they're still up 25%, and then you saw this nice sharp decline, which again may make this a nice buying opportunity. With regard to the dividend, they pay a juicy 4.8% current yield right now. A little bit of a higher payout ratio, but of course this is a REIT, so a payout ratio is not the best metric to take a look at. You can evaluate their financial statements and determine how much of their funds from operations they're paying out, which is somewhat of a better metric with regard to payout ratio for REITs. 5-year dividend growth rate at around 4.4%. Not too shabby once again. We like to see dividend growth rates for these companies between 5 to 10%. So they're a little bit shy right there, but hopefully over the next couple of years, if they are able to collect rent and expand their business, they can increase that dividend growth rate. And they are a fresh dividend aristocrat. They have grown their dividend for 26 years, so they just met that 25-year threshold this past year. And of course, this is great to see. Hopefully they can continue to grow that dividend over the next couple of years and long into the future. Their dividend is still safe right now with a ranking of 70, so nothing too worrying on the short term about that dividend. Very considered safe, so probably not going to get cut anytime soon. The final dividend aristocrat on our list today is McCormick, another boring company, but of course in your portfolio it's always solid to have some boring companies out there, currently trading just below $190 a share. 1-year chart, they are up 18%, so they saw the March lows, but have surpassed and reached new all-time highs. 5-year chart, you can see they're up 136%, so beautiful long-term price appreciation with McCormick. If we're taking a look at their dividend, a low starting yield at only 1.3%, but of course you are getting that nice price appreciation that we just saw. Sustainable payout ratio at only 43%, so lots of money to grow that dividend long into the future. And they have a nice high 9% dividend growth rate, so of course you are getting a lower starting yield, but that dividend is growing rapidly at around 9% per year on average. And of course you are getting beautiful price appreciation over the long term when you are holding McCormick. And they have been doing this for around 33 years of dividend growth. And that dividend is still safe with a score of 80, and of course 81 plus on this dividend safety score would make that dividend very safe. So they're only 1 point away from becoming a very safe dividend. So this company very unlikely to cut that dividend anytime soon. So of course these were all 7 dividend aristocrats that you can hold into your portfolio right now. Dividend aristocrats have a history of outperforming the S&P. It'll be great to see if they can continue to do that over the next 10 to 15, 20 years. But of course, we will not know that for sure until we look back at the results 20 years from now. But of course, they are stable companies. They do a great job of increasing their dividends each and every year, and they may be a great part of your portfolio. So take a look. Always do your own research before investing. And as always, I post videos every single day, so I will see you in tomorrow's video.